Hello everyone, my name is Karan Sehgal and we will continue with the presentation on IFRS 15 revenue from contract with customers. In today's session, we will cover step 4, which is allocating the transaction price to the performance obligation in the contract. The different concept we will cover today would be how to estimate the standalone selling price, allocation of transaction price based on the estimated standalone selling price, how to allocate discount, variable consideration, and case studies which will help us to understand the concept in a better way. Once the transaction price is determined, it needs to get allocated to the identified performance obligation. The allocation of transaction price happens at the standalone selling price for each obligation. The idea is to depict the consideration to which the entity expects to be entitled in exchange for transferring each of the performance obligation to the customers. There are two steps involved. Firstly, determining the standalone selling price, and the second step is to allocate the transaction price based on the standalone selling price. Now, what do we mean by standalone selling price? It is a price at which the entity would sell promised good or service to the customer. The best evidence of this is an observable price from the standalone sales of good or services to a similar situated customer. The determination of standalone selling price happens at the inception of the contract. Under the new standard, revenue recognition is never deferred or postponed because it is difficult to determine a standalone selling price. If the standalone selling price is not directly observable, then it needs to be estimated. The following are the suitable methods to estimate the standalone selling price: an adjusted market assessment approach, an expected cost plus margin approach, a residual approach. Now let's discuss all these steps in detail. As for the adjusted market assessment approach, by evaluating the market in which it sells the good or services, the entity needs to estimate the price at which the customer in the market would be willing to pay for those goods or service. The entity can also refer to the price offered by the competitor for similar goods or services and adjusting the margin accordingly. The next method is the expected cost plus margin approach. As per this approach, the entity needs to calculate the cost for each performance obligation and adjust for the margin for that particular good or services. The last method is the residual method. Under this approach, the standalone selling price is estimated by deducting the standalone selling price for other performance obligation in the contract from the transaction price. However, the residual approach can only be used if the following criteria are met. The entity has not established the price of that good or services, and the good or service has not been sold on standalone basis. The entity sells the same good or service to different customers for a broad range of amounts. Significant judgments would be required in scenarios when the standalone selling price is not directly observable. Entity needs to set up a process to collect the relevant data points to estimate the standalone selling price. These prices needs to be revisited regularly as and when the market condition changes. When estimating the standalone selling price, the entity needs to select it from the ranges of prices, as the standalone selling price is expected to vary from customer to customer. It has to be kept in mind that the range needs to be narrow and based on the analysis that maximizes the observable inputs and supports the assertion that any price within the range would be a valid pricing point if the performance obligation was sold on a standalone basis. Allocating the transaction price. Once the standalone price is determined, the transaction price is allocated to each performance obligation based on the standalone selling price. Scenarios where the stated contract price is an acceptable estimate of standalone selling price for all the performance obligation in the contract, the allocation process is very simple. However, if the stated contract price is outside the range of an estimated standalone selling price, then additional calculation would be required. Now let's look at a case study to understand this concept in a better way. A sells the following product to B: X for $100, Y for $200, and Z for $300. The standalone selling price of these products are as follows: X in the range of $90 to $100, Y in the range of $190 to $200, Z in the range of $290 to $310. Now, as the price stated in the contract is within the range of standalone selling price, the transaction price of the three products would be X $100, Y $200, Z $300. Allocating discount. A discount exists if the sum of the standalone selling prices of the good or services in a contract exceeds the consideration payable by the customer. A discount is allocated proportionately to all the performance obligation in the contract based on the standalone selling price, unless there is an observable evidence that the discount is attributable to only some performance obligation in the contract. This might be the case if a contract is for the supply of three goods, but only two of these are frequently sold together at a discount from the total of the two standalone selling price. Let's look at a case study to understand this concept in a better way. A enters into a contract with B to sell three products, X, Y, and Z. The price of these three products are X $25, Y $35, and Z $45. The total transaction price would be 25 plus 35 plus 45, which is $105. The standalone selling price of X is between the range of $20 to $30. The standalone selling price for Y and Z are $65 and $75. Y and Z are normally sold together at $100. Well, it's very clear that X is in the range of standalone selling price, so there will be no need to make any changes in the price of X. But as Y and Z standalone selling price is quite different from the contract price, and it is also seen that Y and Z are sold together at a price of $100, it is clear that discount should only be allocated to Y and Z. In case of Y and Z, the discount would be allocated as shown in the slide. $65 divided by 140 into 35, that is $37 for Y. 75 divided by 140 into 45, that is $43. So after the allocation of transaction price, the revenue would be recognized for these three products as follows: X $25, Y $37, and Z $43. Allocation of variable consideration. Variable consideration may be attributable to one or more performance obligation and not to all performance obligation in the contract if the following criteria are met. The terms of the variable payment relate specifically to efforts to satisfy the performance obligation or transfer distinct goods or services, and the allocation of the variable consideration entirely to the performance obligation or distinct goods or services is consistent with the objectives set out in the IFRS. Let's look at the example to understand this concept in a better way. A enters into a contract to provide a printer and post-contract services. The price of the printer is $100 and the post-contract service is $25. In case A is not able to resolve the problem with the printer within 3 working days, then A needs to pay a penalty of $10 to B. A expects to pay a penalty of $10 to B looking at the historical process. In this case, as the penalty is specifically related to post-contract services, the variable consideration is not allocated to the overall contract but only to the post-contract services. The transaction price would be $100 for the printers and $15 for post-contract services. Well, this brings us to the end of the session, which was step 4 based on the allocation of transaction price to the performance obligation. Stay tuned for the next session in which we will discuss how the revenue is recognized in the contract. Thank you.